The Fed will end quantitative tightening this year. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Heresy Financial. The 10th of January 2025. The Federal Reserve's monetary policy has been a dominant force in the economic landscape in recent years, and its actions in 2025 will be closely watched. One key development anticipated is the cessation of quantitative tightening, QT, a process aimed at reducing the massive balance sheet the Fed accumulated during the pandemic. Understanding the path to this point, along with the factors at play, is crucial for gauging the economic outlook. To appreciate the current situation, we must look back to 2020. In response to the devastating economic impact of the COVID-19 pandemic, the Fed engaged in unprecedented monetary easing. This included slashing interest rates to near zero and unleashing an enormous program of quantitative easing, QE. Effectively, printing money, by purchasing trillions of dollars in treasury bonds and mortgage-backed securities. This infusion of liquidity was meant to stabilize markets, support employment, and prevent a deeper economic collapse. While it achieved those goals to a large degree, it also laid the foundation for future challenges, including inflation. As inflation surged in 2022 and 2023, the Fed pivoted sharply, embarking on a path of aggressive interest rate hikes and quantitative tightening, QT. QT involves allowing maturing assets on the Fed's balance sheet to roll off and, in some instances, selling assets directly into the market. This process reduces the money supply and aims to cool down the economy and bring inflation under control. However, QT hasn't been without its complications. As the Fed reduces its holdings of Treasury bonds, it indirectly puts pressure on the government to borrow more from the open market, potentially raising the cost of borrowing for the U.S. Treasury. This adds a layer of complexity to the financial system. The Fed also maintains a reverse repo (RRP) facility, a tool that allows financial institutions to temporarily park excess cash with the Fed in exchange for securities. Historically, it served as a safety valve, absorbing excess liquidity in the system. However, in recent years, the RRP facility has seen a significant surge in utilization due to the vast amount of liquidity floating around as a result of the prior QE programs. As QT continues, the question remains whether the RRP will continue to play the same role or if the liquidity it absorbs will eventually dry up. As QT continues, the question remains whether the RRP will continue to play the same role or if the liquidity it absorbs will eventually dry up. The massive QE operations of 2020 created an unprecedented amount of money in the financial system. While QT is intended to drain that liquidity, the process unfolds slowly. The persistence of the RRP utilization suggests that there's still ample cash available. However, as the Fed continues to unwind its balance sheet, the system will become progressively leaner. This process will influence the cost of borrowing, and possibly the level of risk assets people are willing to take. The move by the Fed to conclude quantitative tightening in 2025 marks a significant shift in monetary policy. While the immediate impact might be a reduction in upward pressure on interest rates, the lingering effects of 2020's money printing and the complexities of unwinding such a large balance sheet mean that the economic path ahead remains uncertain. Investors and economists will be closely scrutinizing the Fed's actions and the resulting market responses as 2025 unfolds. The lessons learned from this period will undoubtedly shape the future of monetary policy for years to come. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: dinarrecaps.com